Now, with the price of gold down by almost a third over the last year, and with the Fed announcing the start of QE tapering, the question on everybody's lips is, what next for the yellow metal? Well, here to discuss this is Charlie Gibson, Head of Mining at Edison. Charlie, welcome. Now, back in November 2012, you set the long-term gold price at $1,676 per ounce. Are you sticking with that price?
Well, not exactly, but not far off. The price of $1,676 per ounce came from a long-term correlation between the gold price and between the US monetary base. And what we've done is we've since updated that analysis and we've added a refinement to it. So we've looked at the gold price not only in terms of the monetary base, but also in terms of inflation. And what we've done is we've rationalised those three things into one overarching theory, which will cover the gold price, which will cover general prices, and will cover the US monetary base. Now, to cut a long story short, not 1676 exactly, but not far off. And what we're saying is it'll be a bit lower beforehand, basically because of the drag on the Western economies, but then it'll recover more strongly afterwards. So for this year, for example, the price is currently about $12.50. We're looking at about $14.48 for an average for this year, and then that would rise to over 2,000. So it would rise to 2,070 by 2020. So that's an increase of a little bit over 6% a year in dollar terms.
So what does this mean for general prices and inflation?
Oh, well, that's a very good question. Now, if you look at what's happened to the monetary base, it's come from 0.8 trillion before the crisis to 3.1 trillion in the middle of last year, to probably 3.6 trillion at the end of last year, and by the time QE3 is over, it'll probably be of the order of 3.8 trillion. Now, that alone would imply a gold price of about $2,000 per ounce. For general prices, there is a very, very close correlation historically since 1959 between the monetary base and between general prices. And for that sort of increase, what we'd be looking at is prices orders of magnitude, maybe up to 4 times higher than they are currently. So let me put it in the context of inflation for you. If the monetary base historically has grown by more than 4%, there has been a problem with inflation. Now, in the last 6 years, the monetary base in the US has grown by 100%, 20%, 30%, 2, and 40. So, in my opinion, there is an inflation genie which is unquestionably out of the bottle. It's just a question of how, when, and where it expresses itself. And of course, within the context of gold, high inflation is generally good for the gold price because it's a real asset. It's seen as protection from inflation.
So where do you think inflation can go to, and what can the government do about it?
Well, the figure I'm going to give you for inflation is going to seem extraordinary, but what I need to stress is that what we've seen in terms of the increase in the monetary base has been absolutely without precedent. The last time we went through this was something like the 1970s, and the increase in the monetary base was a fraction of what we've seen in the current crisis. So we calculate the long-term inflation rate, given the increase in the monetary base, all other things being equal, would be of the order of 10.7% in the US economy. Now, that sounds very large, so the question is, what would the government do about it? There are two obvious things they could do about it. One is they could contract the monetary base again. That's only happened twice since 1959, and in each case it was by a very small amount. So I think it's fairly likely, historically, what we see is governments, the Federal Reserve, they don't like to contract the monetary base. But if you were to look at the gold price and say, what does that discount? Well, where it is currently, that would discount the rolling back of all of QE3 and some of QE2. The other thing the government could do is they could raise interest rates, and we could go from a scenario of negative real interest rates to positive real interest rates. That would probably cut about $200 off the price of gold. Less earlier on, more later on, up to $400 later on. Even so, you look at the price of gold and you would say that discounts currently an increase in interest rates and also the rolling back of all of QE3. Now, if they were going to roll back all of QE3, why did they put it in place in the first place? So I think both of those two things would be very unpopular and highly unlikely scenarios.
So what's a more realistic scenario?
So the scenario I think we're going to be left with is the government trying to manage these prices over as long a period as they can. So I think we will have a period of heightened inflation, not hyperinflation, but what they need to do is they need to draw out those price increases over a long period of time, so 10, 20 years. So I think we could have inflation between 5 and 10%. I think as long as the unions don't ask for inflation-busting wage increases year after year, that will allow the government to keep interest rates low. That will protect the economy. It will also have the effect of inflating away Western governments' debts. Western governments' debts about 100% of GDP. If you can double nominal GDP but keep your debt the same, then you will halve that down to what is regarded as an acceptable level of 50%. So I think what you could see is you could see inflation running at something like 7% for 10 years, something like that. And as long as interest rates are able to be kept low, then I think that's the scenario we're looking at.
Charlie, thank you very much for joining us today. If you'd like any more information, please do visit the Edison website.